Good afternoon, everybody. Today we are going to get into Chapter 12 and we are going to talk about investing. As we get into our last unit of material, at least new material in the course. So when we're investing, we're taking our money and giving it to somebody else, and in return, hopefully we're going to make some money for what they're using it with in the meantime. So, to get into investing, we've got to be thinking about the future. And hopefully having more in the future than we have right now. And improving our financial well-being. So it takes a lot of diligence in putting money away and putting money through these various avenues that we're going to talk about so that hopefully it can grow to what we want it to so we have some secure funding later on in our lives. So talk about some of the different avenues we can go about for investing. And you can see some of those things here. And where we go to obtain some of those various investments. So the first thing we're going to talk about are bonds. So bonds is essentially debt. It is a loan that a organization is taking out, and rather than going to the bank and getting all the money from them, they'll go to a bunch of individual lenders to get a bunch of smaller loans that'll total up to be a large amount of money. So any one of us can invest and loan money to a corporation or to a government. Corporations can take their excess cash and invest in bonds. Governments can invest their money, or various investment funds that we'll talk about in a little bit. So the only people that can, or the only entities that can issue bonds are C corporations and government entities. So if you look at a lot of the major projects that may be going on in your city, in your county, in your state, those are going to be financed more than likely through a bond issue. So that they get the cash now to pay for it, and then whether it's collected through taxes or special investments or special assessments on your property, they'll collect the money over time to pay off the bond and pay the interest. So we've got the face value that we'll be investing in, generally in units of 1,000. And then the coupon rate is going to be the amount of interest that is going to be paid on it yearly. So it could be a fixed set interest rate. It could be a floating interest rate. The maturity is what date you're going to be paid back then in the future of your original loan. Let's just say $1,000. So whether it's over 1 year, 2 years, 5 years, 10 years, etc. And then it's a possibility that they have some flexibility within the bond agreement that you can redeem it early and get paid back early, or the corporation can call it back early and say, we're going to pay you off a little early to probably save some interest. If you get into municipal bonds, the interest that you earn off of them are tax-free. Interest that you would get on bonds of corporations, that's going to be taxable income. And then the bonds of the various organizations, you're going to have to look at what's the risk associated with that organization. What's the odds that for sure you're going to get your money back? And essentially, just like you have a credit score, you'd have to evaluate the entity issuing the bonds. The higher interest rate, more than likely, the more risky that company is going to be, and the chance you won't get paid back. So you have to take that into account. We can also invest in the stock market. So in the stock market, we're becoming owners of that corporation. So we're purchasing shares of ownership. As the corporation is profitable, it may pay back its owners with a share of the profits. And it does that in the form of dividends. And you'd have to do your research with the corporation and see what their history is for paying dividends. A lot of tech companies, you've got a chance to profit from the stock, but not a lot of them pay dividends. Apple didn't start paying dividends till after Steve Jobs died. A lot of years went by without paying a dividend. Google does not pay dividends. Our corporations, our stock in our corporations, is generally, depending upon the size of the corporation, if it's a publicly traded company, that's going to be traded on a stock exchange. The most famous ones here are the New York Stock Exchange, of course, and NASDAQ are our options. And a lot of the famous companies that you know are going to be traded on one of those stock exchanges. And we'll have a question in your homework where I want you to look up one of those companies and evaluate whether it's something you'd want to invest in. Another investment would be in the form of commodities. Commodities are resources that are being traded. So examples of those resources would be like agricultural commodities, you know, in the various types of markets, pork, cotton, soybeans, essentially, and all those other types of things. So we could be in oil or gas, precious metals, gold, silver, things like that. So those have been very popular as investments in the last few years. You can also invest in currency of other countries. And those are going to have various risks tied to them depending upon the health of the economy of that country compared to our own. Futures are looking at trying to set the price for those things in the future and trying to essentially hedge the bet of what that price change could be. Options are the right to buy or sell something at a certain point in the time in the future. You can have options tied to stock and being able to buy additional shares of stock, hopefully at a lesser price than it'll be going for at that time. And you can try and make some money off of that option. We've got various types of funds that we can invest in. A fund is essentially a portfolio of investments. So putting together many different things. So what you can do through a fund is putting many different things together. You can hedge your bet and not have to invest individually in all types of individual stocks and have to deal with all the individual fees for buying and selling those stocks. So that's an example. So a mutual fund, all types of investment companies are going to have mutual funds that they've put together with various investments that they like. And then, like I said, can help hedge your bet and lower your risk. Index funds and exchange-traded funds, you're going to be looking at things within the stock exchange. Examples would be the S&P 500, which is made up of the largest 500 stock or companies on the New York Stock Exchange. Or you're looking at something of the Dow Jones Industrial Average, if you've heard of those. It's made up of major companies. And they're all trading for mega bucks. An exchange-traded fund is a fund that's been put together within the stock exchange and then essentially divvied up into shares. And those shares will trade, and the value of those shares will go up and down, similar to the individual stocks. And you can search for them just like the ticker symbol of any individual stock. So like I said, bonds are a form of debt which can be used by corporations and governments. It can generally be so if you want some safe interest that you can count on year after year after year, get into bonds, especially with municipal bonds, like I said, tax-free, and you don't really have to worry about the government going out of business. The U.S. Treasury is not going out of business anytime soon. Most counties, states, cities ain't going out of business. We've had a couple of cases where counties or cities have filed for bankruptcy, but generally that's going to be a safer investment. Corporation bonds, pay attention to the health of that company. What are they using that money for? Do they need that money to stay afloat? Which is kind of looking at MoviePass, if anybody is familiar with that. Just did a bond issue where they need cash just to survive. Or somebody like Verizon that's doing a bond issue, they use the cash and invest in infrastructure and growing their company. If we want to use equity, we can invest in stocks. And then we can profit on the change in the price, or we can profit off the dividends that they pay. And those are for publicly traded on exchanges. We can go through brokers, or you can go sign up for your own account through Ameritrade or any other electronic broker and take care of it yourself. Commodities are trading in natural resources. If anybody's seen the movie Trading Places, the end of the movie, they're trading commodities at the New York Stock Exchange. Mutual funds or index funds, they're going to be collections of stocks, once again, to diversify, to separate yourself, not put all your eggs in one basket, and try to protect yourself, once again, trying to give yourself less risk by going into these funds of all different types of investments, different types of stocks, maybe some real estate mixed in, things like that. So the next part, we're going to talk about planning. We're going to talk about an investment policy statement. We're going to look at investor return. Once again, we'll talk a little bit more about risk and coming up with your strategy. So your investment policy statement, you're looking at what are your goals? What are we going to do with this? So why are you making that investment? What do you want to achieve? Is there a certain level of return, certain level of capital that you want back? I mean, obviously, we're putting the money in so that we can make money. And then what type of risk are you willing to accept as part of your investment? And then what kind of constraints do you have? What's limiting you? An easy constraint would be, how much money do you have? Because obviously we don't have unlimited resources to put into the stock market. And then other things we can look at are, what are we going for? What type of assets do we want to invest in? What kind of time frame are we looking at? Are we considering it similar to retirement planning, and that we're in it for the long haul, 20, 25, 30 years? Or if it's something we're looking to maybe take some risks to make a quick buck, getting into a younger company that's growing, hoping that our stock is going to take off. And then also you got to factor in what are your liquidity needs? What are your cash needs? So we don't want to empty out our checkbook to make some of these investments because it could take a little more time to get our money back if we need our cash in a pinch. So we've got to do our research, make ourselves knowledgeable as far as how risky is that investment? What's the company history for a stock? Same thing for a bond, like I mentioned with MoviePass. Is it a risk that they're not going to be around to pay you back? What's the experience of that company? And you can look and see over time as far as when have they paid dividends, that they've met their contractual interest payments for bonds or anything like that. And then, of course, we got to factor in taxes, what tax obligations we have. Once again, interest going to be taxable depending upon whether it's in a company or whether it's in municipal bonds. If you've got stock that has profited, looking at what percentage of capital gains you're going to pay when you sell them. There may be specific legal requirements tied into bond financing. And like I said, being able to get your cash out is going to be more difficult there. You know, they're more than likely have set payment times. And at the maturity, you may not be able to get your money out of there before then without selling it on a market at a loss. So just go into it with some planning. I would recommend talking to a broker, talking to somebody that can inform you at first. I'm just picking out some highlights, but I am in no means an expert in investment. You know, coming up with your goals, what you want to achieve, and then finding the various assets that can help you achieve those. And as part of your assignment, I'd like you to come up with that investment policy statement for yourself. What would your goals be for investing? What's your risk tolerance? What's going to constrain you from that investment? And start working on. And then take into account what's the time frame. How much cash do you have to invest? What are your liquidity needs? Factoring in taxes down the line, et cetera, et cetera. Another thing that it mentions in the chapter is social investment. Social investment is looking at companies that essentially believe like you do. So if you're a very green and environmental person, maybe you'd want to invest in companies that share those values. If you're not a fan of companies that have moved their production overseas, maybe you wouldn't be invested in that type of company. The next chapter, part of the chapter, we'll talk about return. So return is basically, what do we make it? So through capital gain, the price going up, through any income that we've received, whether it be interest for a bond or dividends for a stock, what percentage of our initial investment are we getting back? Are we making here? And our rate of return is going to be done in percentages. So what percentage of that original investment are you getting back? So obviously we want the higher percentage as we can get. Depends upon how that stock's going. Depends upon how the economy as a whole is going for those bigger funds and what that return is going to be. And you can look at history and try to use history to predict what type of return you're going to get. At the very least in income and dividends, you can look back, and if the companies do pay dividends, you can see that every quarter they pay 75 cents. Insert number here. So that's part of your return, part of your income that you can count on as part of making your decision. And that can also be through tangible resources. You know, I mentioned very easily a little bit ago real estate. Real estate could be an investment. You can invest in those tangible assets. You know, what the value is going to go up on that real estate is going to be your return. If you rent it out, the rental income that you get from it would be part of your return. So obviously we want a positive return greater than what we're paying. And we've got to take into effect what's the opportunity cost of not having access to my cash because it's invested in whatever way, and what's the risk that we ain't going to get our money back. Because obviously there's going to be no guarantee. So we've got to deal with that investment risk, that the return that we're hoping for may not happen. So we've got to deal with then that difference between what we're expecting and what actually happens. And they refer to that as standard deviation. If you've taken stats class, you've had some fun with standard deviation, or if you're going to take stats class in the future, you'll have some fun with standard deviation. But basically, the greater the standard deviation, the greater that gap, the greater the risk. And that's fine as long as you're willing to accept it. You know, go big or go home. I'm taking a greater risk. I'm hoping to have a greater return, but understand that you might not. And we could lose some money. So we've got different risks discussed in our textbook: economic risk, industry risk, company risk, asset risk, and market risk. So as far as economic risk, looking at the economy as a whole, what are interest rates? The Federal Reserve sets interest rate quarterly. You know, basically what the banks are paying them to get cash, and then that's going to affect the rate that the bank charges us for getting loans. But the higher that is, the higher costs are going around the economy for everybody. You know, we got to look at an inflation. Costs are going up all around. What we're paying for things then, that's tied into the interest rate. As the interest rate is going up, more than likely inflation is going up. And then depending upon our investments, maybe going up or maybe going down accordingly based on how that company is affected by inflation. Unemployment's also going to tie into how strong the economy is as a whole, looks at the unemployment rate. And then obviously what happens in the economy is very cyclical. Ebbs and flows, there are down times, there are high times. You know, there's a lot of things out in the financial news these days is, you know, we recovered from a severe downtime, you know, 8, 9, 10 years ago. we've been doing relatively well here for the last few years. When's the bottom going to fall out? When are we going to cycle down? So depending upon when that happens, maybe it's not a good time to get into investments because we got the risk of that drop coming. We got to look at specific industries. Going back to what I mentioned about costs, how are costs being affected on their specific industry? You know, a lot of stuff in the news here these days about tariffs that are getting added on to specific items, to specific resources. Well, that's going to affect costs for a company. So those regulations are going to affect the resource costs and could have a negative effect on that industry that we may not want to invest in until that gets straightened out. Once again, going to be cyclical. Some industries move with the economy. Some industries move counterproductive to the economy. You know, even if the economy's down, if you look at our basic needs, our basic requirements, those companies are still going to be strong in that time. You know, if you're thinking about food, if you're thinking about something like Walmart. There's going to be risks to the specific company you want to invest in. What competition is coming into that industry? Is it going to knock them off the block? Blockbuster did not pay enough attention to Netflix at first. And they don't exist anymore. What types of financing does that company have? Looking at their balance sheet. How much debt are they carrying? How much interest do they have to pay out each year on debt? Is that affecting the efficiency of that company? And if you're going to be investing in a company that's on a stock exchange, all this information publicly available. You can look at any company's annual reports, quarterly reports, and see how their numbers are doing. Asset classes is looking at what are we investing in? So what are our portfolios made up of? Do we have stocks? Do we have bonds? Do we have commodities? Do we have real estate, et cetera, et cetera? What's all going into our portfolio? What's the risk? Do we have a boom or bust on some of those stocks that they're very risky? If we're into some bonds, what are our interest rates? And once again, what's our liquidity with our portfolio as a whole to be able to get out of some of those things? And then we get the same thing going into the market. You know, the financial crisis, the housing industry crisis of a few years ago brought in more regulation on Wall Street, on the bankers, on investments. You know, this has been coming and going. There's some regulations that have been adding on, but then there's other things that have been taken away throughout the last few years. But there's going to be a relationship between our risk and return. Obviously, if we're taking greater risk, like I said earlier, we're going to want to make some money from that. But our return is going to come about from income from capital gains. We can calculate that. We want to know what percentage return are we getting. Are we getting 2%, 5%, 10%, 12%? And obviously, the greater the better. And we're going to want to compare that to what's our goal? What are we hoping to get? Obviously, if I've got an investment over the next 35 years, what am I shooting for on average to get each year so it'll build up to what I want by the time I retire? And we took a look a little bit of that a couple of chapters ago when we were doing retirement planning. But obviously, things may go awry. And one statistical way we can look at that is looking at standard deviation and looking at specific risks. So diversification. Like I said, we can't put all our eggs into one basket. If we're going to have some risky things, we want to include some safer things as well. If I'm going to invest in new companies, I may want some old standbys that I know are going to be around. Whether that be, like I said, doesn't look like Walmart's going anywhere. Would be a less risky investment. Something like Procter & Gamble, that's in a lot of industries and a lot of consumer goods, is going to be a relatively safe investment. And then look at diversifying, not maybe having all stock, but mixing it up to some bonds, some money market, some real estate. And all this stuff we can do in our retirement plans as well. And you can go, and once again, like I said, talk to an investment advisor with some of these things. Tie it into what are our goals, what are we investing for. If we want to be more Johnny on the spot, and as things are going up and down in the market, we're going to be watching things every day. We're going to be trading things fairly regularly and looking at when things are up, making our quick buck, getting out, investing in something else. If we're more passive, we're investing in it, we're letting it sit, and we're seeing what happens over the next few years. And in that case, we're more than likely getting into more funds. Whereas for market timing, for doing more day trading, as it's called, we would be investing in individual stocks ourselves, selling them quickly. So here's an example from our textbook of diversifying. So what percentage of our total portfolio is built up in all these different assets? And you see here in this one, spread out quite a bit. So we're mixed up in about 5 different things. So we can see here regular stocks, international stocks. So just like I talked about the New York Stock Exchange and the NASDAQ, there's going to be stock exchange throughout the world. And all those companies will have the same risks that we'll have. And then you've also got to factor out getting familiar with that country and what economic risks are going on over there. And that'll be another question we have in our assignment. I just want you to research what are some other avenues for international stock exchanges. You can see here they got part of it in high yield bonds. So those are normally going to be, like I said, more risky companies. You get a higher interest rate, but a chance you won't get paid back. Not as much. I would recommend that a higher percentage be in those tax-exempt bonds. Once again, just for the tax advantages of that. So diversify, diversify, diversify. Mix up all your investments. Don't put all your eggs in one basket. And then you can decide how active or passive you want to be, depending upon your goals, how into your investing you want to be. I had a client in my tax practice a couple of years ago. When I got their stock sheet at the end of the year, they had like 350 trades. So they were very active and trying to take advantage of the ebb and flow of the market on a daily basis with their investments. I'll have other people that 1 or 2, it's basically just sitting there and waiting to see what happens. It's up to what your risk tolerance is, how into it you want to be, how much studying you want to do, and things like that. So that is a little bit on investments, a basic enough to start you out with. If you want to get further depth on it, I recommend that you read the remaining chapters of the textbook as they go more in depth in stocks, in mutual funds, etc., and those specific items.